And here's a look at where markets ended the week after we saw the Federal Reserve's preferred measure of inflation falling below 3%. 2.9%, the slowest annual rate in nearly 3 years. And the economy blew away expectations in the fourth quarter, growing at more than 3% instead of the expected 2%. All of this ahead of the first meeting of the Federal Reserve for 2024 is next week. Joining me now, former Kansas City Fed President and former FDIC Vice Chairman Thomas Hoenig. It's great to have you here. And I first want to get your impressions of this last inflation read that we got before the meeting begins next week. Does this change anything, do you think, for Jerome Powell and company?
No, I don't. I think it's a modest improvement. It's still well above the 3% target. So the discussion this week will continue to be not whether, but when to lower rates. And I think the issue of March will become more controversial, and on to May will be the more likely discussion as they go forward, because the numbers came down, but only modestly, and the GDP number was far above expectations, as you said, 3.3% annual rate. So those are very good news, but it also means that shouldn't be in quite the hurry to reduce rates.
Well, this rate cut discussion, this push and pull between the market and the Fed is very interesting. One point that's been made is it's not the stock market that's going to push the Fed to start to cut rates. It's going to be the Treasury market that's going to actually push the Fed to act. What do you think?
Well, I think that's a real issue. I think part of it is that they would like to lower rates, but the amount of debt that has to be financed is enormous, $500 billion in a quarter on an average basis. Who's going to fund that? Well, we know that the international side is slowing. China isn't buying as much, Japan and so forth. That leaves it domestic. That means you have to crowd out private investment, or the Federal Reserve has to stop its quantitative tightening and re-engage in buying government securities, which will, of course, put downward pressure, designed to put downward pressure on interest rates that otherwise rise. And that's going to be part of the discussion. Yeah. And that will affect the time going forward, I believe. Yeah, there's a lot of debt.
We're not saying that destruction of the job market. Next week we've got another jobs number coming out, December jobs report. So we're not saying the destruction of the job market. We're not seeing inflation hit that 2% target. I had someone tell me we're not going to see 2% inflation until 2026.
Well, that's a possibility because, first of all, you're right. The important point to remember is fiscal policy is still expansionary. Both the federal level has expanded this quarter. The state and local governments are spending more than ever. There's a lot of money out there, and the liquidity in the market, despite what people might say, is fairly strong. So there's a lot of demand being created for this market, and that's why the Fed really cannot afford to begin to ease rates anytime soon, I believe. But that will still be part of the discussion, because on the other side of things, they'll say rates are well above what's called the equilibrium rate. Investment is weak. The consumer should slow. So let's ease now and ease in so that we avoid a recession. But that will be the other side of it. But the spending is going on very substantially. And I think the economy will continue to see inflation as we go forward. Not rising inflation necessarily, but if they lower rates too soon, then you will get a reignition of inflation. And they know that.
Before you go, I do want to ask you about the consumption spending number that came in, because the expectation was a gain of 0.4%. The number came in up 0.7% for spending for the month of December. So Americans were spending, and they spent more. Sure, it was the holidays, but on the other side, we found out that the savings rate went down to 3.7%. So consumers spent more and they saved less. What were they doing? They were using their credit cards. They were going into debt. But what does that mean for the future?
Well, it's pretty obvious. If they're going to continue to spend more than they earn, then we'll see the delinquency rates on the credit cards begin to rise, and we're already seeing some of that. And that will, in fact, slow the economy forward. But the question is timing. And also, I think the consumer has been spending down its excess savings. That may be pretty much depleted, but it has been doing that. taking advantage of the opportunity to re-leverage, and also operating under the assumption that I think much of the market is, and that is the Fed will step in and take care of things should things go awry. So I'm going to spend now, and you have that attitude, which is causing spending, I think, to actually accelerate when we expected it to slow.
All right, Thomas Hoenig, thank you for joining me. Appreciate it.